Okay, welcome back to the Crypto Minute. We've got a very, very important topic. We're going to talk about sector rotation and how it relates to Bitcoin and cryptocurrencies today. So we're going to first take a look at some of the things that are actually happening in the market. And then later, we're going to look at where does Bitcoin and cryptocurrencies fit into this whole macroeconomic cycle. All right, so as we know, a business cycle manifests itself into four main stages. We have expansion, peak, contraction, and a trough, which is really the bottom. All right, stock markets are a leading indicator usually, okay, and we look at their valuations to determine where we're at in the cycle. I'm going to show you some areas of what we're at currently, and I will discuss those further in later in this video. So please stick around to the very end when I open up all the can of worms concerning cryptocurrency, where it fits in and what we should be doing now. All right. And as always, please subscribe. It doesn't hurt anything. It doesn't kill you. Please. I'm trying to retire from teaching. Okay. I have kids living in the house. The wife continues to buy on Amazon. My only way out is maybe through this channel. Please. I don't want to cry in front of you. All right, let's get back to this. All right, now we understand that sector rotation is actually very important for investors. And there is a macroeconomic cycle. Please refer to one of my former videos on exactly what the cycle entails. When some markets are, some sectors are up, the other ones are down, and we could use this to our advantage. All right, so we can assess possible performances of each sector during each phase of the market cycle and be easier to select which stocks or cryptocurrency, depending on whatever that phase may be. All right, we can also, which I've been doing lately, is buying put options on some stocks, knowing damn well it was going to go up. And how did I do that? I dollar cost average in. I bought some puts one week, bought some puts the next week, and finally bought some puts. And what did I see finally in the third week? Market started to go down. So I was losing, winning. Okay. And that usually doesn't happen within a 3-week time period. But when we get to the bottom of this, that's how we're going to average our way back in. All right. Remember, this is only for educational purposes. I am not a stockbroker, and you need to invest at your own risk. All right. So we know that stocks can be classified into many different sectors based on their products or services or whatever they're offering. For example, like energy sector includes oil and gas and many other energy related companies. All right, like the housing market, anybody that has to buy, sell, fix, build, anything having to do with houses. Home Depot is even affected somewhat by the housing market itself. All right. So we have to look at supply and demand dynamics, which is crucial to definitely understanding where we're at and where the performance is. For instance, we could have horrible weather conditions within the next couple months, and we could see energy prices starting to skyrocket just because some facilities are out. So there are some weather-related problems that can occur. These are sometimes called black swan events, and I also have a video, if you look also at an earlier video that I'd made on specific black swan events that could happen in September. All right, so every sector has a suitable valuation metric, and it appears that it shows with its growth. And we're going to be looking at what its CPI is for specific companies and sectors later in this video. So we can look at the price to earnings, but what happens if the earnings are wrong? I heard Robert Kiyosaki say, and Raoul Pal say, the earnings are way off. So you can look at price to earnings, but if they're not going to be growing in the future, and this is in the economic cycle where that actually does occur. So let's talk about the four main cycles, basically. All right, we first have an expansion phase. Expansion is a phase where the business activities all around increase in operation and full momentum. This is the result of gross domestic product, GDP, growing, and we see a rise in employment, consumer confidence, and other macroeconomic factors such as stock and crypto prices. Fully equitable markets and crypto normally do well in this phase, so it's also referred to as economic recovery. When did we see this? Well, we had a full crash in March of 2020 2020. And what do we see? About by April, May, June. And that was a real sped up version of how markets actually operate. So what crashed the hardest? We saw the energy sector. We saw some tech crack hard, the financial sector, the housing, the non-discretionary sectors fall really hard at the very beginning. And those were also some of the first ones that actually come back as well. So we saw that in 2020. So think about that. That's when I decided when energy was at zero, I bought. I have proof of it. I can show you my portfolio. That's why I've said I've outperformed the market, and which is why I'm trying to lend you some information about how you can actually use reasonable thought and that you already possess. And I believe the power is within you. You have the experience. You have the life experience. You have the judgment. Don't rely too heavily on others. I'm just trying to present some overall facts of what have happened and some common sense approaches to investing in both cryptocurrency and real estate and the stock market. So we also have a peak. Now we hit that in probably late 2021, early 2022, when the market was at its all-time highest. And how do we know the S&P 500 was at what, 47.29 in some place in January? So peak is the highest point of any economic cycle when the business activities are soaring to new heights every day. This is the phase between the end of the expansion and the beginning of contraction. All right, the peak period is characterized by all around optimism in the market. Income, employment, output, and price levels all tend to rise during this time period. And we call it FOMO, fear of missing out. And some of my friends got into the market. I warned them, just hold, because this is not exactly the best time. They see all of us making money, and then all of a sudden they go, oh, I can do that too. And over the long term, if they have patience, and that is the hardest thing for people to learn. Look at me, I'm old. I've been through this. I've been through economic downturns. I've seen my portfolio drop by 60% in 2007, 2008. I watched my house crash to 50% its value. Patience. Given enough time, that will come back. But I think there's some alternative approaches that I'm trying to do this time to see if I can't actually take what I know and some of my wisdom and actually turn that into a little bit more money. All right, so after contraction is recession. And a full recession is a business cycle. It's in full contraction phase. And this depicts a general slowdown in all activities, and they're starting to intensify. Macroeconomic indicators usually involve a decrease in gross domestic product, and you're starting to see it come down. So investing, spending, capital expenditures per capita, reduce, and negative indicators such as joblessness, inflation, and housing prices are leading indicators into this cycle. All right. During this phase, many of the firms and household goods and services start to fall. We also look at non-discretionary. Who's buying cars? Who's buying new houses when it's at its full downturn? That's when you should. And that's the hardest part that people try to, they avoid, because they want to see the market start to come back up before they get into it here. And should they be dollar cost averaging here? Possibly. And here? Definitely. All right, so there are some markers that we will talk about when we're at the full bottom of a recession and possibly where that will be at in this market cycle. All right, which is the trough. The trough on a wave is at the very bottom. The peak is the crest, the bottom is the top. So we're now looking at the very bottom. We have fear and misery everywhere. Everything you're hearing on TV is misery, and things are going to continue to get much worse. That's when you start dollar cost averaging in. It's happened every cycle, even though some people think, oh, well, it's going to be a 42% drop this time, or a 50%. Or maybe I keep hearing 80% in this case, in this market conditions. Follow your own heart. Use your own investing style. Maybe when it hits 50% or 40%, you put in 10% of your money. And it hits another 10% down, you put in another 20% more. And so you dollar cost average as it goes down. Now, what's going to happen is you're going to watch your portfolio fall. But you've been through this, that it will eventually go back up. And you just bought it at a huge discount. Remember the S&P was earlier, I said it was 47.29. What happens if you're buying it at 3,200? Now you bought it at a 25 to 40% discount, somewhere in that range, given enough time. Patience. Can I get a little patient? All right, that's for all my Guns N' Roses fans. But the trough marks the end of the recession, and the transition phase into expansion is coming. Now, can that last a while? Yeah, it can last 4 to 6 months. It can just kind of go just like this. And then all of a sudden, you're going to see the Fed start to ease. And that usually, and between that and the 10 and 2 year bonds, you should start to see reversals. And that is marking basically the bottom and the trough at that time. All right, so remember that the stock market is definitely forward thinking. And some people like to think that they're like 6 months ahead. I say about 4 to 6 months. But there are some things that we can do to kind of negate this and try to figure out, are you looking at something called RSI? And I will leave some links in the video below about what RSI actually is. Remember, relative strength index is a ratio between the two assets. Let's try to keep this a little bit more simple. If you see a stock going, and it's already it's crossing the 50-day moving average, it usually means it's going down. It's probably time to sell or buy puts in it, which means you're betting it's going down. And if a stock is crossing and approaching the 50-day moving average and crossing it, it's usually on an incline and on a bullish trend. Those are very, very simple ways to indicate the direction of stocks. And remember, you can't have reversals at any time. All right, so how does this affect cryptocurrencies, more importantly, for some of you that would just watch this video? Just to hear this. Well, when we look at cryptocurrencies, I believe it's one of the newest sectors. And I'm going to kind of place it near tech and financials and real estate, in that kind of range. It really does seem to follow what tech does, and it can rise rapidly and it can fall rapidly. And it is one of the leading indicators that we will see start to approach when we are in a expansion phase or the beginning of a new cycle. So we have to wait for that trough, and we're not there yet, which is why I'm thinking we're going to have at least one more or two more big pushes downward. I did predict that it would hit close to 1700. We looked at some technical analysis. I now say that we are going to take out that bottom at some point. And it's really because of where the tech sector is in the sector analysis. It still has room to fall. You've seen Apple decrease at least 5 to 10% in the last couple of weeks, but it is very overinflated. And if you look at price to earnings ratios, the problem is again with that, it's the earnings. We keep thinking that there's earnings are going to be the same, but if you look at what every recessionary market shows us, is that that's not in fact true, that earnings are based on proposals and what we're thinking. But what happens if the earnings are completely wrong? And the earnings are much less, then the valuation of the company is much less. And can they follow the broader market? If everything else is selling off, it has waves, as we've seen with buying and selling in both cryptocurrency and the stock market. So we should see a major drop in cryptocurrencies. I don't know whether that's going to actually hit 12,000, but it's going to be below the 17,500 that we already had. So when it starts dropping into that range, I'm going to start dollar cost averaging in at some point, back in. Obviously, I'm a long-term holder of many different projects. I have those on Ledger wallets, and so they're offline, and look at some of my earlier videos about that as well. And that's one thing I've learned about cryptocurrencies. I have a portion that I've just saved onto a ledger wallet, and then I have a portion that I'm just going to buy and sell with. So my long-term belief, most of my money is in there, like 70%. But I am playing with 20 to 30% to seeing whether I can ride things up, sell it, and then wait for indicators to show me and technical analysis to show me to buy back in. All right, please like and subscribe to this video. Puppy, come here. Come here. I got to show you my beautiful puppy. Come here. Oh, here she is. Oh, all right. See, I have to feed this beast. All right. Okay. All right. As always, have a wonderful and blessed day.